Hi everyone, today I'm talking about 3 stocks I'm buying in January 2022. So I bought these 3 stocks last week and I will probably continue to buy these stocks through the month of January if the prices are right. So I'll spend a few minutes on them, talk about why I'm buying them, so we'll take a look. Now if you do want to know when I'm buying companies in real time and selling companies in real time, make sure to join the Patreon, links in the description. There's 2 exclusive videos a week on there, as well as the Discord with 600 members on to talk to about stocks. The latest video that we did on there, which was talking about Micron, PayPal and Disney and my thoughts on them at the moment. So if you do want to join that, links in the description, as well as some brokers if you want to start investing. And number 1 is Square. Well, I can't say Square anymore, but Block. I'm still not very sure on this name change. I don't know what you guys think about this one. But currently getting on to Block or Square, it's currently $161 and it has had a very good 2020. And in 2021, it's one of those stocks that basically hasn't done anything. In fact, it's actually down on the year. Join the list that's waiting for you. There's a long list at the moment. But yeah, down 27% on this year today. But it's a company that's done pretty well over the course of the last 5 years. Since reaching the high of $289, it has had a massive pullback. It's lost over 40% of its value, and I think it's just one of those companies that just got to a valuation that was just a little bit too high. Really, I think one day in the next 5 years, I think Square will get back to this sort of valuation as the growth in the company catches up to it. Now that it's had a bit of a healthy correction, I'm looking at this one thinking it's a pretty decent valuation. Now, few people will question that it is a 127p ratio, but that's only because it recently came to profitability, and when you do have that, they tend to be quite high P ratios. But going forward, you'll probably see that P ratio drop a fair amount because they are starting to pull in quite a decent amount of profit. Currently 75 billion market cap company, so it's still a pretty decent size. I think it will be a even bigger company in the future. And I am going to say that I do feel like while it is on this kind of drop where it just keeps falling down like a lot of stocks are, one of those things that don't try time the bottom kind of thing. It could go down a lot further, but you just don't know when. And, as me, as someone that's investing for the long term, 2 to 5 years, if it goes down 160, 140, 120, I'm not too bothered. For me. It's one of those that I can just keep buying more, averaging on, and the longer the market goes down, I think it means more money on the upside. And I think since it was founded in 2009, it's done very well for itself. Now, getting stuck into the financials, this company has done very well this year, even after some very hard comparisons. The growth has still been pretty good. You'll see that a lot of their transaction revenue here makes up a big majority of it. That's still growing at a very healthy rate here. That's mostly done through the Cash App. Subscription and service-based revenue, that's obviously a lot of the things that help businesses. That's still growing at a huge amount. That's still growing at nearly 50%, which is great. The hardware revenue, which was the first reason why I actually originally invested in this company back in 2017, doesn't make a big chunk of the revenue up now, but still growing at a pretty good rate. I'm seeing more and more of their hardware actually being used in a lot of stores at the moment. And their Bitcoin revenue is growing, but not as much as what it was doing previously. You look at the 9 months, look at that increase over the last 9 months. Now, the Bitcoin does make up quite a big chunk of the revenue up, and that does make me kind of nervous about this company. I'm not, if you watch me for a long time, you know that I'm not a huge crypto fan. So the fact that it does rely on Bitcoin quite a bit does make me a little bit nervous, and that's why Square will never be a massive position for me. It'll always just be an average size position in the portfolio, as I think it does have a lot of diverse income. As you can see, it has quite a big moat out here, but one of those incomes that does make a big chunk does make me a little bit nervous. Now, this does work in the other way as well, is that I think a lot of you guys know I'm not really a massive crypto fan. I don't really own any crypto, but I think that crypto could do well over the next kind of 5 years. So having this stock basically gives me some good exposure to Bitcoin and crypto basically. So even though I'm not really a big fan of crypto and I don't have any plans to own any crypto whatever, this stock does kind of give me the benefit of that, okay, if it does carry on doing what it's been doing, at least I'll have this one stock that will really benefit from it. And at the end of the day, if it does kind of slow down, if it doesn't do that well, this company still has a lot of parts of the business that should do okay for it. So yeah, I do like this stock from that point of view as well. That gives me some exposure to an area that I don't really have that much exposure to. Now, one of the biggest growth drivers in this company is the Cash App. So if you don't know, it is in the US and the UK only. So that's, sort of says how much expansion they've still got to do worldwide. Cash App that allows you to transfer money to basically another user. And then from there, they've also expanded the amount of services that are in the Cash App. and this is really popular at the moment. I believe it is in the US the #1 finance app out there, so that says a lot about how successful this has been and will probably continue to grow over the next few years. And the thing as well, it's not been around that long. You look at that, it's 2013 since it was launched. We're not even over 10 years since this has been around. And since the launch of the Cash App, when it was just simply to send money to one another, since then they've just added more and more features in. So one of the big things that you would have seen is now, from just having cash there, transferring it, storing it as a bit of a mini bank basically, you can now use that to buy stocks on the app or buy crypto on the app. So I think what Square will do, Square have been more of a what PayPal should have been, and they basically go, oh, you know what we could add in is this, and because they've added so many little mini features in now, I think Cash App will be very successful for many years to come. And one of those new features, and they have made a recent acquisition, which was Afterpay, will actually let them expand into the loan industry now. So they are Square since the last year have now added in a feature where you can actually borrow money as well. So yeah, you basically have a mini bank starting to come here, a mixture of a bank and PayPal, which is pretty impressive. Now obviously the other one main competitor to this is PayPal. PayPal realised we've been a bit slow to adapt here, so they got Venmo, and Venmo has been very successful, but I don't think it has improved or moved in the right direction as much as what the Cash App has. And if you look at the difference here, the gap that it used to be back in 2016, and the amount of ground that Square has basically made up through the Cash App on Venmo, they basically caught them up, and it's been neck and neck, and recently it's starting to move a little bit into Cash App's favour. So yeah, obviously two brilliant things here, and obviously I'm still a very big fan of PayPal. I think PayPal's a great company, but I think the Cash App does slightly have it here, and as you can see here, they've done very well to catch up to the likes of PayPal. And the big thing with Cash App and Square in general, they don't really have too much international growth. They basically have been a lot focused on the US, but they have basically the whole international area to grow at the moment. And they are in the UK, but outside the UK, they haven't really grown that much more than what they could have basically done. And you look at the revenue here, the revenue on the US is still growing at a pretty decent rate here, but you look at the international's doubling at the moment, and look at the difference in revenue. The amount of growth that they still have international to go at the moment, it is a lot. There's a lot of improvement that they can make there. So this here is a bit of an untapped market, and they could continue to do that, and looking at it is doubling up at a really good rate at the moment. And the other part of the business, rather than the Cash App, is the hardware. This is where I bought it originally, so they could really expand this hardware business a lot more. And also the software, this makes up another big chunk of the revenue. The software in businesses is becoming more and more popular, and the amount of services they do launch, it keeps extending. So at the moment you've got them covering all the individuals here with the Cash App, but as well as that, the seller's point of view and the amount of software programs they've got to help basically set up companies at the moment, there's a lot out there. So they've got a lot of these services as well that are very popular with businesses as well, and this area of the business, like we showed earlier, is still growing at a really impressive rate. And even though this company is not cheap at the moment, the metrics are a lot cheaper than what they have been for a very long time. So if we look at total enterprise values to revenues, you can see here that through 2018-19, it's basically been double figures, and then recently what's happened, it's now dropped all the way down to a 4. So from that point of view, it's pretty cheap, same on a price to sales ratio. And if we look at enterprise value of EBITDA, you can see here that they've traded around 75, 60, 75, 75, recently jumped up to 100-ish, but you can see here it's down at 80. So even though it's not like the lowest it's been for a long time, it's about level. So it could go lower from here, but historic from these metrics, it's about in line with what it normally trades at now after this pullback. And it's the very same on market to free cash flow as well. They're pretty much in line here as well. So Square isn't going to be a big company in my portfolio, but I think it just gives me some extra coverage in the payment space, the Cash App, Bitcoin as well. So I do like this as just an average size position, and I think in the next 5 years, when I look at Square, Block, where is it going to be in the next 5 years? Do I think it's going to be the same sort of valuation, or is it going to be higher? I definitely do think it will be a lot higher from where it is right now. So I am picking up a bit of Square on this dip. Number 2 is a very underrated company in my opinion, a company that has a lot of growth, but as well as having a lot of growth, it is now moving into the stage of putting in very good amounts of profit going forward, and that is Pinterest. Pinterest is a company that I have owned, I do own, so I'm averaging up on this one Originally, I bought in 2019. I started buying around about the $21 and averaged down a fair bit in 2019. And then even more when the CV times happened. Sold a lot of my position off at 200-300% gain, but still kept some shares because I still thought it would be a very good company. But since then, the market has decided, okay, this is only a CV stock, and I disagree. I think it's going to be a very good platform going forward for many years. But the market disagrees, and they have sold off the stock a huge amount. And this stock had a 52-week highs of $89, and since then, it's now going down to $35. Now this one is 23 billion, it trades at a 67p ratio. Now when you do look at this on a forward basis, this actually drops a huge amount because this company is ramping up the profit amazing at the moment. So when you look at the growth on this one and the profit that it will do, this is where I get really interested in this one. Now going into Pinterest's recent earnings, which took the stock down a massive amount, and I was really surprised because I thought the earnings were really good. They beat AEPS by a really good amount. The revenue, and let's not forget this was on very hard comparisons, did very well, 632 million, 43% year-over-year growth, a beat on revenue as well, so this is growing at a really good rate. Now the only reason why it went down is because monthly active users were a little bit weak. Now, I don't know about you guys, but going into these earnings, I was like, of course it's going to be weak, because what were we doing a year ago? Everybody was sat at home. Everyone was like, oh, what shall I do? I'll go on my phone. I'm still bored, what do I do? Okay, let's get ideas of something that I can do to fill in the time. Maybe go on Pinterest and find ideas of gaming setups or recipes or furniture that I might want to buy or DIY furniture, everything like that. People are looking for things to do. So obviously, I don't know about you guys, but this is clear to me that this is obvious that they were going to be a little bit weak user growth. Now in the long term, I think they will go back to the user growth because obviously they're very hard comparisons, but naturally people start joining Pinterest again and the user growth will move in the right direction. So for me, that wasn't the big deal. And the big thing as well is like the users they do have, they're going to monetize a lot more. So even if the user growth isn't amazing, what they'll still be able to do is get more money from the advertising. So even if the users don't grow a huge amount, they'll still be able to increase the profit and the revenue in a massive way. But I do think this will sort itself out. Now, funny enough, Pinterest is a very more popular platform in international than it actually is in the United States. Now the problem is that they don't actually do much advertising international. That's only just recently started happening. You see here that recently the international is starting to, it's doubled up on the international side of it. US is growing still healthy, but look at the international growth, and that's going to continue growing. And the thing is that international growth could easily take over the United States growth when they start making more from their advertising. Because what Pinterest did originally is they only advertised on US. They didn't actually advertise on the international side until about 1 year ago. That's correct. Pinterest made no money off their international users until about a year ago. And now what they've done over the last 12 months is they've expanded their international side of it. So you can see here, Pinterest international ads are now supported in 29 countries. And these countries aren't really, slower developed countries. You talk about big international countries here like Germany, Austria, Spain, Italy. And look here, Pinterest expands advertising business to Latin America. This was on the 5th of April. Until the 5th of April this year, Pinterest wasn't even advertising in Latin America. So yeah, it's absolutely bonkers. So this is how this is growing so quick, because it hasn't historically advertised to them, and now it is starting to do that. And the more impressive thing with these sort of numbers is that if you look at the average revenue per user on the US side of it, you've got $5.55 here, which isn't too bad. Look at the difference between the international. It's 38 cents. So the gap between the ad revenue per user in the US and the international is a massive difference. You think about even when this gets to $1, the amount of improvement that will be. So the gap between United States and international at the moment, massive gap. So this has got a lot of room to kind of ramp up here. And even if you look at the United States at $5.55, if we just flick across to the Facebook numbers, theirs is US and Canada $46. If we look at the worldwide, $9.01. So you look at what Pinterest are doing, the amount of room they have to improve this is unbelievable when you look at these numbers. And this is how Pinterest have just got to the point of view now, is like the revenue is going to move in the right direction and the profit's going to make more and more profit, because they have basically done zero advertising, and the advertising they've been doing is for dirt cheap. So they're going to see massive amounts of revenue increase, and the amount of profit they're going to make now is pretty good going. So this is going to be very good going forward in the future. And the great thing as well, it's very good on the balance sheet. It's got a lot of cash on there, no debt on there, and obviously there's going to be a lot of cash going to that balance sheet going forward. So I think we could see a couple of things like share buybacks going forward. And I think generally as well, when you look at this company here, it does have the markings of a potential buyout for someone. We know PayPal was a little bit interested a while ago, but yeah, overall I think that when you look at the share price of Pinterest, does it reflect how good it's had a bit of a sell-off here? But I think the sell-off is very unfair compared to what the company's going to be doing in the next coming few months, years. So yeah, I picked up a few more Pinterest shares recently. And the last one is Teladoc. So Teladoc had a very good year because obviously it does telehealth, and telehealth has been very popular because of the CV situation. Share price did really well, and then it reached 52 highs of $308, and since then it has fallen off a cliff a huge amount. It's lost 70% of its value, and it is currently trading now at a 14 billion company. Now the share price itself hasn't been at $90 since the 17th of January, so that's a while ago. To think that basically the share price is where it was at pre-CV times, and the revenue has moved massively in the right direction since then. It's really benefited from the CV situation, and I think all that it's done is brought the use of telehealth services forward a huge amount. And you look here, the amount of research and what the TAM is going to be going forward, and the TAM growth is going to be an absolutely huge amount over the next period. And you can see here the prediction from 2021 to 2028. There's going to be massive growth in this industry, and I think all the CV's done is it's brought a lot of revenue forward, but it's also brought the transition to more telehealth services, which are going to be huge going forward, because it's going to save so much hassle between traveling, switching between appointments, saving money as well. It's going to come a lot more mainstream going forward, and it's one of those industries that hasn't been disrupted for a long time. But I think this is it. I think Teladoc are going to be the market leaders, first mover advantage, and really going to benefit from that. Now, even though the shares are $90 now and the same price as where it was pre-CV, quite often people say, well, the reason why is because it's increased the amount of shares it's outstanding, and then that doesn't actually line up with the share price. Now, that's kind of true. They have increased the shares that are outstanding by a little bit, but you got to look it into context. I think one thing recently, and I think there's a certain YouTube channel that has put into people's heads that, okay, if you keep putting shares out, it's a really bad thing for the company. Now, it is obviously not ideal, but you've got to take it in context of why they're doing that. Why have Teladoc, issued such an amount of shares? Now, they haven't increased it by a crazy amount. I mean, it has gone up a lot, but you've got to realise that the issue in shares was because that they bought Livongo. Now, when you take into context that the reason why they're offering these shares is to get Livongo, what's that going to do for the company? Well, it's going to get rid of, not a competitor, but it's going to add them into an income stream that they needed. And when you think over the long term, 5, 10, 20, 30 years, what's Livongo going to do? It's going to help a lot of customers come to them. Them customers will probably buy a lot more Teladoc's products, and it just makes it more the complete company. So when you look at, okay, sure, there's some shares that have been and now outstanding, and they've diluted shareholders, but what benefits does that bring in? When you look at the benefits now, I don't know why you would say you would rather them not dilute shareholders than do this. You would want them to have Livongo in here. It completes the company. So I mean that's one criticism that I always see used against Teladoc, and I always disagree, because I think the benefits of Livongo in the next 5, 10, 20 years will easily outweigh just diluting the shareholders. And the big thing here is that you look at the revenue increase of what Teladoc were expecting with the Livongo deal. They're absolutely smashing out of the water to what they're doing now. We're going to look at around about 2 billion, potentially 2.5 billion, 3.2 billion. And the thing as well is, when you look at the shares outstanding, you look at what Teladoc were doing pre-CV at 553 million. Look at where we're going to close right now, 2 billion. So the revenue has massively outperformed what the share dilution is. The revenue's gone up a massive completely in the right way, which is absolutely brilliant. And a few people also point to the losses on this company. But if you actually look at the gross margins on this, it's pretty good. The only reason why they're not getting to profitability is because they want to expand. You want them to take more market share, and the profitability will come in the future. It will happen if you look at the company and the gross margins. Keep expanding into the TAM, keep your market share, and this will be a very successful company going forward. And once again, from a metrics point of view, they're back at the cheaper side of it. We're going back to 2017 here, 6, 7, 8, 12, 6. and we had a little bit in the teens here through 2020, but look at where we're at right now, 6. We've not been at a 6, or this is the lowest we've been in the last kind of 3-4 years. The last time we were touching a 6 was 2018 and 2017, and even on adjusted EBITDA here for enterprise value, you can see here we're down at 45, and we've not been there ever. We've not really been at this sort of valuation from this point of view as well. So there's a lot of metrics here pointing it to that it's cheapest that it's ever been for a very long time. And when you look at the progress the company has made since that point of view, the company has made really good acquisition in Livongo. The revenue's gone from 500 million to 2 billion, and a lot of the telehealth service demand has been brought forward a huge amount, and it's been more mainstream. So when I look at the drop off in share price, sure, the valuation might have got to crazy points back in at the start of 2021, but does the valuation right now justify of the progress that Teladoc has made and will make going forward? In my opinion, no. I think in the next 5 years we will be talking about Teladoc being at least a 50 billion company in the next 5 years for sure. So while I see that happening, I will pick up some more shares in this, as I think it will be a massive area going forward. So those are the 3 stocks for January 2022. Hope you enjoyed the video. Let me know what you're thinking of buying as well in the comment section. Hit that like button if you're new and you found the video helpful, subscribe, and I'll see you in the next video.